Hello, everyone. Welcome to a special edition of Let's Talk Markets. I'm your host, Dave Lauer. This is like a market structure crossover edition. This has never happened before. We have the two hosts of the most popular market structure podcast out there. All right. Now that this is really saying something, I think. Okay, it is number one of two.
There you go.
Shh.
Ronan, Ryan, and John Ramsey from IEX. Thanks for joining me, guys. Really great.
Thanks, Dave. Thanks for calling out that there's only two of these market structure. We've been saying we're award-winning leaders for years now.
God bless you, Dave. So glad to be. Usually in Box and Lines, I always imitate.
For Dave's
Ronan's
listeners,
Irish accent. So,
John has a shit Irish accent that sounds like Mrs. Doubtfire, but just let him go.
That's all right. I got it out of the way, so we can.
He's like a Mississippi bloodhound. It's best to let him finish. Anyway,
I really want to see John dressed up as Mrs. Doubtfire. Guys, come on.
That'll be the next podcast, Dave. Well.
So John and Ronan come to us from Boxes and Lines. As they say, they're award-winning market structure podcast. And so this is a fun crossover. But they also are at IEX and the Investors Exchange, which I had the pleasure of getting to know them while working with them many years ago and continuing to collaborate over the years. Guys, and any intro you want to give to IEX or what you guys do there?
John, why don't you take a stab at it? This should be funny.
Wait, why do you think that's funny? What about IEX? Well,
yeah.
I mean, so big picture, IEX, which also stands for Investors Exchange, is a fully registered stock exchange, just like New York, NASDAQ, and others. But it is unlike those in that we sort of pioneered the use of both technology and particular order types to protect ordinary investors from the effects of speed-based trading strategies. So that's kind of like where we kind of initially made our mark is, and also distinguishing ourselves in other ways in the way that we disseminate market data to participants. We don't charge participants the way that the other big exchanges do. We just try to do things in a way that is fairer, more transparent, a simpler model.
Perfect.
That's pretty good.
All right.
Yeah,
there you go.
We might move him over to the sales team.
Look at that. John knows what you guys do. It's great.
Yeah. And it was, I mean, and your listeners who are readers, and I'm sure some of them are, IEX was also the group that formed the company was profiled in the book Flash Boys that Michael Lewis wrote back in 2014, I think.
Very good, John.
Thank you.
Excellent. So
I'm actually impressed, Dave.
Wow. Are you going to give me more money? You're going to up my my bonus now? No. All right.
So that's weird, because what you intimate in that is that these other exchanges, these other self-regulatory organizations who are supposed to be balancing the public good and free and fair, efficient markets with their profit motives, you're saying maybe they don't quite get to that standard, reach that standard relative to you guys?
Yeah, I mean, I don't even know if we're intimating it. We're expressively saying it, to be really honest. I mean, we felt, when we founded the company, the institutional investor, right, was badly misrepresented within the industry. You have these big pension funds, they send an order to a broker, the broker takes the order, and they can do a lot of things with it, but at some point it likely makes it towards an exchange. And who's the exchange there to serve? You would imagine the investor, whether they be retail, whether they be institutional. And the exchange's largest customers are a completely different customer base and a completely different customer base that they cater to. So Investors Exchange was kind of our idea we were originally founded and funded by a group of institutional investors. And I guess we couldn't call ourselves Investors Exchange till we were officially an exchange, but now we can.
Can't actually use that word, right? Until you're approved.
Yeah, so we wanted to call ourselves Investors Exchange, and actually our first website was going to be www.investorsexchange.com. But then if you stare at it, all you can see is the words sex exchange in the middle.
Oh, no, investor sex change.
Yeah,
Investor sex change.
Yeah. So we're like,
yes. Which could have gotten actually some good traction.
It's
I
a
think.
true
Could have
story.
done good traffic on that. Come on.
Yeah,
You know,
so we pulled it back and made it.
Speaking of Mrs. Doubtfire and the
So before the SEC told us we couldn't use Investors Exchange as a name,
Or investor sex
some
change.
perv of our founders noticed the sex change in the middle, and we changed it to IEX.
but also,
True story.
I think relevant, I think also for your listeners, Dave, we are certainly interested in and actively pursuing ways to be able to provide more protection and better prices for individual retail investors too. Part of the hindrances around doing that is that, as you and I suspect most of your listeners know, vast bulk of most of the retail order flow is all locked up in other places and doesn't generally find its way to exchanges. But we would like more opportunities to be able to take care of those orders too.
Yeah, I mean, that's, as you're describing the genesis of IEX, the misrepresentation of, who your customer is and who you are there to optimize for. It sounds very similar to the retail world where, brokers should be working on behalf of and in the best interests of their users, the people holding and trading stock through them, but that's not who pays them money. It's the wholesaler.
Right.
And so, that conflict of interest is something we've obviously spent a lot of time on. We talk about a lot. So, the parallel there, it's funny. You sort of see conflicts of interest pretty much everywhere in this industry.
Yep. There's no conflicts of interest, you tinfoil hat wearing bastards. Everything's fine.
He is being facetious.
These markets are the most efficient, greatest, bestest.
All right. Okay.
Anyway, sorry.
I hear they're the best in the world.
Yeah.
I'm told with no data. All right. So
I'll be serious.
no, no, you won't. But that's okay. That's not why we have you on here, Ronan. It's for your good looks. JR's here for the market.
There we go. Dave is an honest man.
Brutally, one might say. Yeah. All right.
Here, I'll give you some tissues.
So, all right. But the reason, that I thought it would be great to talk to you guys today, there was a big announcement. It was information that came out that people are now talking a lot about. So to understand this, and I put this up on a post on Irvin. If you're already using our site, go check it out in our market structure and regulation community. If you're not already on our site, well, why the hell aren't you? Go sign up. We have been growing like crazy. We are in beta right now, and we are adding over 1,000 users a day at the moment. And it's really exciting and lots of fun on the community platform on Irvin. But I put a post up there and I said, yesterday, IEX announced a fee structure change. And normally we don't talk much about fee structure changes. That stuff is boring. But this was a pretty big departure for you guys. And so just for background, maybe you want to just give a quick overview of how you used to charge before this change, how most exchanges charge, and what change you've made and why.
Okay, so I don't know to the extent that your listeners really know what rebates are, so I'll explain it a little bit. But generally, the way it works on all stock exchanges other than IEX until yesterday, and we'll talk about that in a second, is they have a model called the maker-taker model. And maker is the provider of liquidity. So if you have 1,000 shares to sell and you put it on an exchange, display it and say, hey, I'm selling 1,000 shares, you've made liquidity. If someone sees that 1,000 shares and comes in and goes to buy it, they've taken liquidity. Generally, the maker-taker model was to attract people to display the liquidity, would rebate them some money. So if an exchange charges 30 cents per 100 shares traded, they might give 28 cents per 100 shares traded back to the maker of the liquidity, and the exchange captures 2 cents. And that's sort of the way it's been for probably the last 20 years at this point, to be honest. So that all sounds well and good. You, the exchange, should be allowed to incent liquidity onto your platform. So you pay one side, just make sure you charge the other side more. Everybody's happy. The thing is, it's grown to a total bastardized, convoluted pricing model where people are now routing orders, not necessarily on in the best interest of their clients. They're routing to receive the rebate. And IEX from day one, and I know Dave, you've been a supporter of that as well. We've spoken out against rebates both before we started IEX and ever since we've started IEX. We supported the SEC in a proposed pilot called the transaction fee pilot, hoping to get rid of rebates. So yes, there's tens of pricing changes per month across the market for exchanges, and there's never articles written about them. And Dave, you probably don't cover them. But for IEX to come out and say, we're going to pay a rebate, I always say to people here, don't get defensive. You light a fire, you walk through it. We're going to get the consternation of the street. But
yeah, can I just add
just don't ask one of your long-winded fucking questions.
I'm not gonna.
It'll be the end.
It'll be the end. I think I can add a little color that will be helpful here.
I have full faith that you will.
So thank you. So in that structure that Ronan just talked about, you have
eloquently
takers and makers very eloquently. The SEC has, in terms of take fees, so fees that exchanges can charge for people to access their displayed quotes. SEC has a limit, says exchanges can't charge more than, we use the term 30 mils. That means 30 cents for 100 shares for almost all stocks. So they established that limit way back in 2005 because they didn't want exchanges to be in a position to kind of impose excess fees for being able to access their best prices. But they didn't address the use of rebates at all. And so what has happened over time is that you have these incredibly complicated pricing structures where individual exchanges sometimes offer rebates at the top tier because it's also a tiered system. So the top rate, for example, for available to only a very few sort of privileged firms could be even 31 or 32 mils. So it could be more than the limit on the take fee. But again, I think the key thing here is that it's extremely complicated with a pricing paths that are based on hundreds of different variables, and some prices that are that essentially are individually negotiated with particular firms, although exchanges don't actually own up to that.
That sounds like a conflict of interest.
It does. It certainly does. Yeah.
Another one. It's
right.
Everywhere you look.
So it's this crazy Frankenstein kind of structure for pricing that IEX has been against and has been campaigning against for from the moment that we became an exchange. And so should we talk about what the change is, and we should talk about I think why it's sort of consistent with that principle.
Just to ground it in, we talk a lot here about payment for order flow, and in our comment letter on the equity market structure proposals on regulation, the proposed regulation best execution, we talked about how payment for order flow generally is both retail internalization, payment for order flow, and exchange rebates. And so as you've described exchange rebates, the conflicts you're describing are nearly identical to those that we encounter in the retail payment for order flow space.
Bingo.
Yes, bingo. Very well said.
Yeah.
All right.
So we announced yesterday that we're going to pay a 4 mil rebate and charge 10 mils to access liquidity on IEX. And let me caveat it where, Dave, I believe we shared the note with you. We sent a note out to several thousand buy-side firms and all of our broker members. And we kicked it off. We didn't want to bullshit and beat around the bush. We said, this is what we're going to do. This is why. But make no mistake about it. If the SEC were to propose a rebate ban again, we would be first in line to support that.
And we'll continue to advocate for a ban on rebates. Yeah. We still think that would be the best result.
But we're learning in a world where you do need to incent different types of brokers or different constituents to come to your market. We were told, and we're actually surprised, to be very honest, that 4 mils, so 4 100ths of a penny, would make such a difference that this would attract liquidity to a market. We've built our market. We didn't get into it with a speed bump. We have a signal to protect clients from adverse selection. And our feeling is that if someone routes an order to IEX in order to receive a rebate, they also get the benefit, or their client, the end client, gets the benefit of a better execution. And our execution quality is better for displayed trading. So again, it's something. This was a very hard decision for us because this has been sort of a religion of ours for years. And I think, Dave, you'll remember we were, really, really, really out there public supporting of the transaction fee pilot. And Unfortunately,
But-
they lost.
But again, I don't want to. I think we need to be clear here that we haven't really lost religion. I think the core principles are that we think exchange pricing should be simple. It should be relatively flat. It should be completely non-discriminatory in that everybody should receive the same pricing regardless of who they are on a per share basis.
That's a great point.
And this is, and we have continued to, and I will certainly be happy to say, I think we're committed to holding to those principles, going forward. So the 4 mil, as Ronan said, rebate is relatively small, but it is also exactly the same for everybody. It is known in advance. And one of the aspects of that is that if there is an investor order that's at the other end of that is sent, that is entitled to that payment, that is an amount that could then be passed back to the investor because you know exactly what the amount is.
And I think people might find this part of it interesting, Dave. So when you have displayed trading as an exchange, IEX until 2020, people would call us like a dark pool exchange. We were mostly dark. We were about 8% lit. We came out with an order called D-Limit, which was a hard-fought order to protect displayed trading because you shouldn't protect the quotes, but don't get me going down that path. We've grown to about 30% lit. As a result of that, I'm not sure if your listeners know about the securities industry processor, but the securities industry processor on a monthly basis credits exchanges, sends us checks for quoted volume and traded volume. And by nature of the fact that now we have more displayed volume, we're getting several $100,000 a month in quoted volume checks. And we were looking for a way initially, rather than on a per share rebate, to credit that back to brokers to say, look, we're getting this money as a result of you quoting here. We want to do what we've always done, charge the people to trade on our venue, as novel as that sounds. And that's how you monetize, and that's how you run a stock exchange. But when we went to talk to the brokers, it's not as easy or black or white as people think. And I genuinely learned this. People can't just take checks. They don't know how to allocate them back. How do they allocate it to which
very weird,
client?
right? Yeah.
It's
I want to give you money.
Yeah. We can trade in billions of a second, but if I give you money, I don't know where the fuck I'm going to put this. Anyway, so we came up.
I would have no trouble knowing what to do.
I know.
If
you have no trouble asking for money at any point of the day.
We will have JR's address posted in the show notes if you want to send
So
money.
in the end, to do it in a very deterministic way so that people could build it into their models, we came to a rate of 4 mil rebate. And like John said, you could trade 1 share here a year, or you could trade 50 million shares here a day, and everybody's getting the same rate. And I will tell you, the interesting feedback that we got when we put out this blast letter I was telling you about went out to a few thousand people, but we had prop firms, regular broker-dealers, agency broker-dealers, and buy-side. And it was universally received very positively, but the feedback was, we like this, it's simple, no tiers.
Right,
Yeah.
and important to stress
Tiers.
that
People
part
kept
of the
tiers.
unfinished part of the regulatory agenda that the SEC has not put out yet any proposal specifically around these pricing tiers, which again we think is highly discriminatory and not justified. So we think the SEC should propose and adopt rules that would either eliminate or greatly restrict the use of these tiers. Fortunately, the SEC has indicated that they do plan to propose some type of rule, so we're going to continue to advocate for that.
Okay, this all makes sense. I thank you for that explanation. And so I think one thing is we've spoken with the SEC about this SIP subsidy that you just spoke about, this money that goes to the exchanges from the Securities Information Processor. And it's an interesting topic because it's a massive subsidy to the 3 major exchange families, right? It's something on the order of $100 million a year per exchange family. And generally speaking, they just pocket it, right? And they fund rebates through extremely high take fees. And so those rebates have to approach the access fee cap, this governmental price controller limit you just described, right? So that is, sort of one approach to making money as an exchange. And you said that you prefer to make it based off of trading, which is novel, but that's pretty fucked up that that's a novel thing, right?
It was novel till about 25 years ago, and everything just went fucking pear-shaped.
Right, exactly.
Yeah.
So what you're doing here is you are not funding your rebates through higher take fees. You're actually funding it from the SIP subsidy, which, if I'm not mistaken, wasn't that the fucking point of the SIP subsidy?
Yep.
Wasn't that the whole point of the thing to begin with?
Well, yeah, I'd caution you to watch your language, Dave. But yes,
I know.
absolutely.
Sorry, I get angry over fee structure.
I'm blushing. I think the guy said,
yeah,
fuck.
Oh my God. Yeah.
What kind of podcast do you run?
Apparently,
no wonder you're number 2. No wonder we're number 1. See?
In the
fucking
universe
hog.
of market structure podcast, anything goes, right? No one's listening.
Yeah.
I can't take it anymore. Yeah, no, it's pretty magic too, because as you were saying on the 30 mils, when we were looking into the SEC's proposals on lowering that access fee cap, we saw on exchange trading something like 92% of volume. One side of that trade is paying the full 30 mils to access the liquidity. So
92%.
yeah, it's pinned almost to the limit so that they can pay the highest rebate.
And the important thing to understand too is that investors, when their orders are sent to exchange, more often are sent to take liquidity rather than to make liquidity. And that means that investors end up bearing the brunt of the costs of trading.
Paying.
Absolutely. Somebody got to pay. It's probably you. If you don't know who it is, it's probably you.
I have not been drinking today, by the way.
I don't know if that's a better comment that's actually.
But in about 2.5 hours,
Yeah.
it'll start again.
All right.
All right. Next
vicious
cycle.
cycle.
We're all drunk, so
Yes.
it'll be a lot funnier.
Yeah.
And have nothing to do with market structure. All right.
Yeah.
So,
Done.
so what you're proposing is take the revenue that the public pays, right? Maybe people don't quite understand. There's this SIP thing, and they don't quite, that maybe it doesn't mean much to them. On Irvin's platform, we show you the SIP feed. We're probably the only platform to show retail investors the SIP feed, to show you the full picture of the market. But that's expensive, right? It's expensive for non-professionals. You're paying $3 per user per month. It's really expensive for professionals and for anyone who's reading that feed. And all of that it's a regulatory mandated feed. That's like the tape, as people might conceptualize it.
And it's a monopoly provider of data that is run by the large exchanges.
Right.
Right. And one would argue run really for the most part for their benefit.
So this is yet another conflict of interest that we have uncovered.
Yes.
You too.
Short episode.
Tell you.
So when the SIP was conceptualized, it said that we need a tape, we need a public feed so everyone can see what's going on in markets. Yep. But let's have the exchanges run it in their under the guise of being a self-regulatory organization, right? Mm-hmm. And therefore they need to be paid to run it. So here's all this money, and the money will, 1, go to running the infrastructure, and 2, the rest should be used to compensate the firms that are establishing the NBBO, and to be used as an incentive for that. Is that correct?
It is correct, and I would just to go a little bit further down the rabbit hole, just so folks understand. The SEC adopted rules several years ago that we strongly pushed for and favored to kind of break up this monopolistic system by allowing other companies to be able to serve as what they called consolidators, competing consolidators. So instead of data being disseminated through this one monopoly, have people to compete to provide the best, most cost-efficient service.
Right. So all of that being said, I like that you're using that revenue for the purposes it was envisioned. At least it comes back to those firms that are creating the data and establishing the quote. It is. I think it'll be shocking to a lot of people that to post an order on IEX before this fee change, a displayed order was free, and that was not enough to bring enough displayed orders onto the exchange. So not only was offering something for free not enough, but you're telling me that 0.4 of a penny is actually going to make a material difference.
4/100ths of a penny.
4/100ths of a penny.
Yeah.
It's actually going to make a material difference here.
Do the fucking math, Dave.
Yeah, I mean,
hey guys, edit that out for Christ's sake. I don't want Dave to look bad. Ask the question again, you moron. No, It's a fair question. I got to be honest. When we looked at it, we were really surprised. But the way that people build their models, right, is they'll take these rebates. Sometimes they'll call them edge. They'll call it mils of edge, right? Yep. You get your performance on an exchange is X. X plus the rebate is your total performance. IEX has great performance, but we don't have the rebate that we had. And we learned recently that we're almost neck and neck, even without paying any rebate. So while we don't charge or provide any rebate today, if we were to just provide that little bit extra, that little edge of 4/100ths of a penny, it can make that difference. So when we socialize that,
you're paying 28 to 32 mils.
Yeah.
If you guys just pay 4, you're now at their level from an execution quality perspective, or slightly better.
That's what we're being told. So look, obviously we filed this and it's public that we won't be implementing this until September 1st. So we wanted to give people 30 days to build it into their models, and then we'll see. But we do think that we'll see some uptick from this. Do we think that we're going to come and jump up and be like one of those large maker-taker exchanges? No. But like, listen, when we did this years ago, we launched in 10 years in October and 7 years as an exchange. Any horse's ass have known for years. We're not fucking morons that if you paid big rebates, we'd grow in market share. You're approved on filing. We could have done this at any point.
Right.
So the whole point is, by taking the punches to the head for a 4 mil rebate, we'd probably get the same punch to the head if we had announced we're paying a 15 mil rebate. But that's not the point of what we're trying to achieve.
All right. Well,
what Ronan means to say, I often try to come up and clean up on what he said.
Translate that. Yeah.
Mm-hmm. He's the cleanup man. Was that not clear? I blacked out there.
No, I think that was clear. Yeah. No, we're.
I held my breath too long. All right, I'm back.
We're making a minor change in order to try to get more people comfortable with posting liquidity here, but it is not at all adopting the model of other exchanges, and we're going to stick to our principles.
Yeah, I can absolutely see why Ronan wants compliance to review this.
Yeah. Oh no, don't worry. I won't have them take out any of the
cursing. That's okay. They've already given up on control.
I don't even think. Don't worry about it. They claim to review all our podcasts. I don't think they listen. Yeah. We take little pot shots in there at them by name. Don't you?
All right. Well, look, I appreciate you guys jumping on to explain this. Anything we didn't cover here?
I think that's it. I mean, I think
I think we nailed it. I think we absolutely nailed it, John.
Nailed it.
One small aspect of market structure reform that a lot of other things to keep your eyes on, but we are going to continue to advocate on all fronts for a whole host of changes that we think will benefit investors. So we value a chance to talk to your listeners and engage with them.
God bless America.
God bless.
Absolutely. Salute.
Cheers.
To you guys. And here's to banning rebates and payment for order flow. I'm glad to hear that you're still on board with that. And,
Yep.
That will be the American way. All right.
We'll see. All right. Cheers, Dave.
All right.
Thank you very much.
Thank you.
All right.
God bless. There's the Irish.
Yeah. All right. Thanks for tuning in, everyone, to this episode of Let's Talk Markets, this crossover with Boxes and Lines. If you don't already subscribe to their podcast, first make sure to subscribe to ours, but then go ahead and look them up too. They're, the inferior, they're number one, but we're coming after them in the market structure space. And again, this has been a fun day. We're releasing 2 episodes today. We'll be here next week to talk about crypto legislation, and that'll be a lot of fun, excitement, and complicated math. So hit that subscribe button, give us a good rating, and we will talk to you.
Oh yeah, we got to say shit like that. Hit that subscribe button.
Oh yeah, there you go.
Okay. Yeah,
that's what all the cool kids do. All right. Do that too. All right.
Cheers.
Bye.
Thank you.
All right. Thanks.
Bye.